10:30 a.m. $40 billion is gone, vaporized, in 30 minutes. That's more than the GDP of entire countries. It vanished into thin air before most traders could even refresh their screens. Now, usually when money burns this fast, there's a smoking gun. When FTX collapsed, we knew why. When Luna went to zero, we watched the algorithm break. When an exchange gets hacked, we see the stolen funds move on the blockchain. But on February 10th? Silence. There was no breaking news. No CEO arrested in the Bahamas. No code exploited. No government announced a ban. The news feeds were empty. Yet $40 billion was wiped off the ledger. This wasn't a robbery. This wasn't a hack. This was something much more terrifying. This was a ghost crash, a glitch in the reality of the market. I'm Daniel Brooks, and the scariest part isn't that it happened. The scariest part is that for the first few hours, nobody could explain why. If you're holding crypto, stocks, or any asset right now, you need to understand what happened in that 30-minute window, because it didn't just break the charts, it exposed a structural failure in the financial plumbing that's still there right now. This is the story of the silent crash. Before we dive in, hit that subscribe button and turn on notifications. What I'm about to show you isn't just about crypto. It's about what happens when liquidity disappears from any market. And the signal we're seeing points to something much bigger coming. To understand how the floor fell out from under the world, we have to look at the days leading up to it. The market didn't just wake up and decide to die on February 10th. It was sick. It had been sick for months. Rewind 3 days. February 7th, 2026. The Bitfinex incident. This was the first tremor. An error occurred at Bitfinex, a major exchange. It wasn't a hack. It was a mistake, a fat finger error. Someone, or something, accidentally moved a massive amount of Bitcoin. $4 billion worth of Bitcoin was sent out. An error, a clerical disaster. Now they fixed it. The money was recovered, the chaos was temporary, but the psychological damage was permanent. Imagine you're walking across a frozen lake. You think the ice is thick. Then you hear a loud crack. The ice holds, but you stop walking. You freeze. You're terrified. That's what the Bitfinex error did to the market. It didn't break the ice, but it told every major investor that the ice was thin. Nerves were shattered. Traders were jumpy. They had their fingers hovering over the sell button, waiting for the next sound. And they had good reason to be scared. Zoom out. Look at the big picture. October 2025. That was the peak. Bitcoin hit $126,000. Everyone was a genius. Everyone was rich. The total market was worth over $4 trillion. Fast forward to February 2026. We'd lost $2 trillion. $2 trillion. That's a slow, painful bleed. For 4 straight months, the market had been grinding down. Prices were dropping. Hope was fading. The market wasn't a fortress. It was a dry forest. It hadn't rained in months. The wood was brittle. The ground was scorched. It didn't need a flamethrower to burn down. It didn't need a massive scandal. It just needed a spark. A tiny, insignificant spark. This brings us to the morning of February 10th. The bulls, the people betting the price would go up, were desperate. They were trying to call the bottom. They were saying, "This is it. We're cheap. Time to buy." They were wrong. The institutions, the big banks, the hedge funds, they weren't buying. They were leaving. They were quietly exiting the building through the back door. This created a specific condition called thin liquidity. I want you to visualize a safety net. Usually when people sell, there are buyers below them acting as a net to catch the price. If I sell Bitcoin at $90,000, someone buys it at $89,900. The price moves a little bit, but it's controlled. But because of the fear, because of the Bitfinex error, and because of the 4-month bleed, the buyers were gone. The safety net was cut. So when the selling started at 10:08 a.m., there was nobody home. There was a void. You had thousands of people trying to run through a door that was welded shut. This set the stage for the most dangerous mechanism in modern finance. It isn't fear. It isn't greed. It's the Bonnet leverage cascade. When the price dropped just 1%, it should have been a normal Tuesday. But in a market this fragile, 1% was too much. Robots took over. Automated trading bots saw the 1% drop and triggered stop losses. This means they automatically sell to prevent losing more money. But remember the thin liquidity? Remember the missing safety net? When the robots sold, there were no humans to buy, so the price dropped another 1%. This triggered the next level of robots. They sold, the price dropped harder. It became a domino effect, a self-fulfilling prophecy of destruction. Bitcoin dropped 2%, then 3%. Altcoins like Solana and Ethereum plummeted even faster. In 30 minutes, $1.5 billion in futures positions were liquidated. This means traders who borrowed money to bet on the price going up were forcibly sold out by the exchange. They didn't have a choice. The system sold their assets to cover the debt. Selling begets selling. Panic begets panic. By 10:30 a.m., the smoke cleared. $40 billion of wealth was deleted. And the most disturbing part? The systems worked exactly as they were designed to. There was no glitch in the code. The glitch was in the market structure itself. The buyers had gone on strike, and the sellers had nowhere to go but down. This wasn't just a bad day. This was a repricing of risk. The market looked at the world, looked at the economy, and decided that crypto was too dangerous to hold. But why now? And more importantly, is this the bottom? Or is this the trapdoor opening to something much lower? To answer that, we have to look at who was actually selling. Because it wasn't the retail guys on their phones. It was the whales. And they know something we don't. To understand the whale exodus, you have to look outside the crypto charts. You have to look at the money itself. The whales left because the cost of money changed. For years, crypto thrived on cheap cash. When interest rates are low, money is trash. You don't want to hold dollars, you want to hold assets. You want Bitcoin, Ethereum, Solana. You take risks because the bank pays you zero to save. But in early 2026, the game board flipped. The macro environment turned hostile. The Federal Reserve, the central bank of the United States, signaled that rates were not coming down as fast as the market had hoped they would. This is the gravity of finance. When rates stay high, the dollar gets strong. When the dollar gets strong, risk assets get crushed. The whales saw this coming. They didn't sell because they hated Bitcoin. They sold because the math stopped working. Why risk losing 20% in a volatile market when you can get a guaranteed 5% return in risk-free treasury bonds? This triggered the sell stablecoin exodus. This is a metric most retail traders ignore, but it's the heartbeat of the market. Think of stablecoins like USDT or USDC as the poker chips on the casino floor. Even if you aren't playing a hand, as long as your money is in chips, you're still in the casino. You're ready to play. But throughout January and early February, the supply of these chips started shrinking. Investors weren't just selling Bitcoin for stablecoins. They were redeeming the stablecoins for actual US dollars and wiring the money back to their bank accounts. They were cashing out. They were leaving the casino entirely. This removed the dry powder. Dry powder is the cash sitting on the sidelines waiting to buy the dip. When the crash started on February 10th, people on Twitter were screaming, "Buy the dip!" But there was no dry powder left to buy it with. The money had already left the building. This explains the violence of the drop, but before I show you what happens next, I need you to understand something critical. What happened on February 10th wasn't isolated to crypto. This is the same mechanism that will hit the stock market. If you want to stay ahead of what's coming, subscribe right now and turn on all notifications. We're tracking the liquidity signals in real time. Drop a comment. Did you buy the dip on February 10th, or did you sit in cash? I want to know how you positioned yourself. Now let me show you the leverage cascade that amplified this crash. In a healthy market, a $100 million sell order is absorbed by thousands of small buyers. It barely moves the needle. But on February 10th, the market depth was paper thin. Market depth is like the water in a pool. If the pool is deep, you can do a cannonball and the water barely splashes. If the pool is shallow, if there's thin liquidity, a cannonball sends all the water flying out. You hit the concrete. That sell-off was a cannonball in a kiddie pool. When Bitcoin dropped just 2%, it dragged the entire ecosystem down with it. Ethereum, XRP, BNB all tumbled 3% to 4% instantly. This sounds small. 3%, that's a Tuesday in crypto. But you have to remember the leverage. The crypto market in 2026 was highly leveraged. Traders were borrowing 10x, 20x, sometimes 50x their money to bet on a recovery. They were betting on a bounce that never came. When the price dipped 3%, Those loans became toxic. The exchanges issued margin calls. Put up more money or we sell your position. Nobody had more money. Remember, the dry powder is gone. So the exchanges sold. This created a feedback loop from hell. The exchange sells to cover the debt, that lowers the price, that triggers the next guy's debt. The exchange sells his coins too. Round and round it goes. In total, over $1 billion in trading positions were liquidated across the sessions surrounding this event. That's not just a number on a screen. That's $1 billion of collateral. Real savings, real houses, real paychecks, transferred from the impatient to the prepared. It wiped out the optimists. It wiped out the people who thought the floor was in. And it signaled a massive psychological shift. For the last 5 years, the winning strategy was buy the dip. Every time Bitcoin crashed, if you bought it, you got rich 6 months later. It was Pavlovian. Crash equals profit. February 10th broke that rule. Investors realized that buying the dip in a high-interest, low-liquidity environment isn't investing. It's catching a falling knife. The psychology shifted from greed to preservation. Nobody wanted to be a hero anymore. They just wanted to survive. This is why the recovery was so weak. Yes, Bitcoin rebounded slightly after the 30-minute burn. Dead cat bounces happened. But the trend was broken. Analysts who were calling for $100,000 just a few months ago suddenly changed their tune. The new targets weren't up. They were down. They started pointing to $38,000, then $40,000. They realized that the $2 trillion wiped out since the October 2025 peak wasn't just a correction, it was a repricing. The market was searching for a new bottom, and it hadn't found it yet. This brings us to the most dangerous realization of all. If crypto is crashing because of liquidity and because of interest rates, what happens when those same forces hit the stock market? Crypto is the canary in the coal mine. It's the first asset to die when liquidity dries up, but it's rarely the last. The $40 billion glitch wasn't an isolated event. It was a warning shot for the entire global economy. The liquidity void is moving. And to see where it strikes next, we have to look at the charts everyone is afraid to show you. The smoke cleared around 11 shots a.m. For a moment, green candles appeared on the charts. Bitcoin ticked up. Ethereum stopped bleeding. To the untrained eye, it looked like a recovery. It looked like the market had taken a punch to the gut, stumbled, and was standing back up. Traders on social media started celebrating. They posted screenshots of their buy orders. They claimed they'd caught the bottom, but they didn't catch the bottom. They caught a falling knife that had momentarily paused in midair. This is the most dangerous phase of a crash. It's called the dead cat bounce. The logic is grim. Even a dead cat will bounce if you drop it from high enough. The slight recovery we saw wasn't new money entering the system. It wasn't confidence returning. It was simply the sellers taking a lunch break. It was short sellers closing their positions to lock in profit. Once those profits were taken, the buying pressure evaporated again. And this reveals the harsh truth about the crypto market in 2026. The trend is your friend until it stabs you in the back. And right now, the trend is not up. You have to look at the scoreboard. Since the peak in October 2025, the market hasn't just stumbled, it's been decimated. We went from a market worth over $4 trillion to barely holding on to $2 trillion. That means half the money in the entire industry is left. The February 10th event wasn't a random accident. It was a symptom of a much deeper illness. It was the market telling us that the price is still too high. Think about that. After losing $2 trillion, the market still thinks crypto is overpriced. This is why the experts aren't celebrating the bounce. They're looking at the floor. Before this crash, analysts were defending the $45,000 line for Bitcoin. They said it was the line in the sand, the unbreakable fortress. Well, the fortress was breached. Now those same analysts are adjusting their targets. And they aren't looking up to $100,000 anymore. They're looking down. The new target? $38,000 to $40,000. If Bitcoin falls to $38,000, it drags everything else into the abyss. That number, $38,000, is critical. It represents a psychological surrender. If we break that, the buy the dip crowd is officially extinct. But here's what most people are missing, and this is crucial. Before you make any moves, share this video right now. Send it to anyone holding crypto or stocks, Because what I'm about to show you applies to both markets. Drop a comment. What's your price target for Bitcoin? 38K, lower, or do you think we bounce from here? Now let me show you why this isn't just a crypto problem. This brings us to the most uncomfortable truth of all. The crypto market is the only free market left on Earth. It trades 24 hours a day, 7 days a week. It never sleeps. It never closes. It has no circuit breakers to stop trading when things get ugly. Because of this, crypto is the raw nerve of the global financial system. It feels the pain first. When liquidity starts to dry up in the global economy, it doesn't show up in the stock market immediately. The stock market is protected. It has opening bells and closing bells. It has regulators who can pause trading. It has a delay. Crypto has none of that. So when $40 billion evaporates on a Tuesday morning in February, that's not a crypto problem. That's a global liquidity signal. It's the smoke before the fire. Think about who's trading these markets. In 2017, it was just retail guys in their basement. But in 2026, it's the same hedge funds, the same family offices, the same high-frequency trading algorithms that run Wall Street. The money is connected. When a hedge fund gets liquidated in Bitcoin, they bleed. They have a hole in their balance sheet. They need cash immediately to cover their losses. Where do they get that cash? They sell their winners. They sell their Apple stock. They sell their Nvidia. They sell the S&P 500. This is how the contagion spreads. It jumps the firebreak. The crash on February 10th was a liquidity crisis. It happened because there were no buyers. Now look at the stock market. The S&P 500 has been running on the same thin liquidity that broke Bitcoin. The volume is low. The buyers are exhausted. And just like crypto, the stock market is addicted to leverage. In crypto, we use futures contracts. In the stock market, they use zero-day to expiration options. These are bets that expire in 24 hours. Pure gambling. It's the same mechanism that caused the leverage cascade in crypto. Trillions of dollars are riding on these short-term bets. If the market drops 1%, the algorithms panic. They sell. The options trigger. The selling accelerates. Does that sound familiar? It should. It's the same script we just watched play out with the $40 billion wipeout. The plumbing is identical. The risks are identical. The only difference is the size of the explosion. Crypto is a $2 trillion asset class. The U.S. stock market is $50 trillion. If crypto sneezes, it wipes out a few billion. If the stock market catches this cold, it wipes out retirement accounts. It wipes out pensions. It changes governments. So what do? You have to stop thinking like a gambler and start thinking like a survivor. The buy the dip mentality works in a bull market. It works when the Federal Reserve is printing money and handing it out. But the printers are off, the rates are high, the liquidity is gone. In this environment, cash is a position. For years, people told you that holding cash was losing money. They said inflation would eat it away. But right now, cash is the only thing that doesn't crash 40% in 30 minutes. Cash is optionality. Cash is the ability to wait. The investors who survived the February 10th crash were the ones who were sitting on their hands. They weren't trying to catch the falling knife. They were watching it hit the floor. They're waiting for the flush. A flush is the final stage of a crash. It's when everyone gives up. It's when the price goes so low that it becomes an undeniable value. We're not there yet. The analysts calling for $38,000 Bitcoin are optimistic. If the stock market follows crypto into the liquidity void, $38,000 will look like a ceiling, not a floor. We could see prices that rewrite the history books, but this isn't about being a bear. It isn't about being a bull. It's about being awake. The market has changed. The rules of 2024 and 2025 don't apply to 2026. The algorithm has shifted from growth at all costs to return of capital. You need to protect what you have. You need to understand that a 30-minute window can erase months of gains if you're over-leveraged. The Bitfinex error was the warning. The February 10th crash was the lesson. But the final exam is still coming. Subscribe to this channel. Turn on notifications. Because when that liquidity void opens under the S&P 500, you'll want to know before it happens, not after. I'm Daniel Brooks, and I'll see you in the next one. Stay liquid.